Most people think they're saving money by managing their own retirement. But what if that decision quietly costs you tens of thousands or maybe even hundreds of thousands of dollars over time? And here's a twist: some of these folks are the smartest, most successful people that I work with. They will still choose to get help. So the real question isn't, can you do it yourself? The real question is simply, should you? So by the end of this video, you'll know exactly which path is the right path for you. A few years ago, I sat down with a couple in their mid 60s, about a month away from retiring. They'd done everything right, saved consistently for decades, managed their own investments very good, avoided debt, and on paper, they looked very solid for retirement. When we actually mapped out everything, the retirement income, the retirement taxes, the withdrawal sequencing, they were really one bad market cycle potentially away from running out of their money, maybe in their 80s, maybe in their 90s, but ultimately not aligning with their long term goals. So they had the same assets they'd always had, but a completely different outcome just based on this strategy alone. And that's what this video is really about. Not whether you're smart enough to manage your own retirement, you really probably are. It's whether doing yourself is actually the better choice. And the answer is certainly a lot more nuanced than most people expect. So let's work through it and start with thinking about the case for do it yourself and why people choose to do it themselves, and if this is the way to go. So there are some real advantages. The most obvious one is fees. No advisor means no management fees, no advisor fees. This feels like a very straightforward win. Here's often the question that almost no one stops to ask. Are you saving money, or are you just avoiding a visible cost while taking on invisible ones? Because mistakes in retirement don't arrive as a tax bill. They may show up as higher lifetime income taxes, lower income overall, poor timing on Social Security, and missing other key planning opportunities. So those costs are more silent, but they do compound over time in ways that are very, very real. So the second advantage, perhaps, is one to look at, which is you have control. You make every decision, there's no middleman, and for a lot of people, that feels right, especially if they've been hands on with their finances their whole working life. But control can also cut both ways. When you go do it yourself, you also carry about 100% of the responsibility, right? So there's every tax decision, every withdrawal that you make on a portfolio, every reaction to a market downturn. One significant mistake at the wrong moment could permanently alter the trajectory of your long term retirement. So, can do it yourself work? Absolutely. But it requires really three key things. First, it requires the time to stay on top of it all. Second, it requires the knowledge to do it all very well and understand the intricacies. And third, it requires a desire to keep doing it not just today, but tomorrow, next year, and doing it for the next 20 or 30 years overall. So most people have one of those, perhaps, maybe two. Very few have all three of these consistently and in place for their length of their full retirement. And so here's where things start to really break down, because retirement planning isn't just about investing, it's about a lot more. So let's talk about this. What do do-it-yourself investors usually miss? So some of the biggest misconceptions that I see is that retirement planning is about just managing their portfolio. While that's really just a small part of the full picture, it's about integrating a lot of the moving pieces that all affect each other. And most do-it-yourself investors focus on one while underestimating the pros and the cons and the benefits and the issues of all the others. So let's start with a couple of different ideas, starting with first the income gap. And that's again the difference between what's coming in from guaranteed sources. Think about Social Security benefits, maybe a pension, maybe rental income, maybe income from an annuity. So if you have one of these, then this is what you could actually start to as your floor for spending each month. Now your investments, they have to come in and fill the gap every year between your expenses and your income for the rest of your retirement. Most people have a rough sense of what this could be, but they've never really calculated this precisely. And imprecision here is quite expensive. Withdrawing too much too early, you risk a great risk of running out of your money in a short period of time. Withdrawing too little, you unnecessarily constrain your retirement and you don't do things perhaps that you wanted to enjoy, as you now have done for decades of building towards this phase. And then there's also things like income taxes. And so a lot of people assume they'll be in a lower tax bracket in retirement. And sometimes that's true. Oftentimes it may not be. Because now you have to factor in other things that are income related, such as your required minimum distributions, usually starting around your mid 70s at this point. You could also create more taxation of your overall Social Security benefits. You have capital gains, interest, dividends, and potentially triggering higher Medicare premiums through adjustments called IRMA. And the order in which you draw from your accounts affect this enormously. Same money, different sequence, completely different tax outcomes. And I've seen 6 figures, even 7-figure differences in lifetime income taxes between people with nearly identical portfolios just based on withdrawal strategy. Social Security timing is one of these decisions, and it's one that people often underestimate the long-term pros and cons of various claiming strategies. So taking Social Security at the wrong time, it could mean giving up tens, sometimes even hundreds of thousands of dollars over a lifetime. So the optimal choice is going to depend upon your health, your spouse's benefit, your other income, and your overall tax picture. Generic advice does not cut it here. And then there's overall behavior, investment behavior. This is one that's the hardest to acknowledge, but it's real. Even disciplined, intelligent investors make emotional decisions often when markets drop, often selling at downturns, maybe holding too much cash, being very hesitant when the plan calls to take action in those moments. So research consistently shows that working with an advisor adds meaningful value, not from better investment selection per se, but from helping people avoid the mistakes that could erode their returns over time. So what do you gain from working with the right advisor? What does working with a good advisor actually get you over time? Some of the biggest things could be that one, most people would usually not fully appreciate until they experience it, is just understanding the planning integration. So most people treat retirement as just a few sets of different buckets. They have investments over here, income taxes over there, Social Security decisions over there, and all these are separate. They're not deeply connected. And so a decision in one area actually ends up affecting every other area. So if we see this as a connected overall plan, then they allow you to make one decision that is coordinated with the others. And so a good advisor doesn't just manage your portfolio, they build a coordinated strategy across everything, across all the different areas of your plan. So one of the first things we do with new clients is build what I think of as a retirement dashboard. This is a clear picture, understanding what you own, that's your assets, what you owe, that's your liabilities or debts, what's coming in, it's guaranteed income in retirement, and then what's expected to go out. Then from there, we can calculate things such as your income gap, the difference between your income coming in and your expenses going out. And then also from there, calculating a calculation that's very important for retirement known as your withdrawal rate, which is the percentage of your liquid assets you need to draw each year to close that income gap. And if that number, just as a starting place, is perhaps in the range of 4 to 5%, you're typically in a pretty strong position for retirement. Higher than that, then potentially some structural changes or adjustments would be needed. And this is not a complicated calculation, but it's a very clarifying one. And most people don't necessarily take time to actually run it. So from there, the value could compound. We could look at other areas such as tax efficiency over the full span of retirement, not just this year or what happened last year or next year, but across decades. And this could mean an enormous difference in what you actually keep long term. So next up will be understanding how to coordinate the right accounts, sequencing withdrawals thoughtfully, and timing your retirement income strategically. And this is where a lot of the real value is created. And it's also where a lot of do-it-yourself plans could leave money on the table. There's also something worth naming directly, which is what this looks like as you start to get older. Do you want us to be managing all of this at age 75 or age 80 or older than that? And unfortunately, what happens if one spouse has handled all the finances and something happens to them? So having a plan, having a professional involved protects both people. And finally, a good financial advisor or wealth advisor functions as a behavioral coach, not just a technical one. They help you stay disciplined when markets are volatile, make decisions from the plan rather than having anxiety, and to avoid the reactive choices that could derail even the best well built strategies. Because in retirement, consistency matters more than brilliance. And having someone whose job it is to hold that line with you is genuinely valuable. So, which is the right choice for you? Here's the honest answer. It's not easy to say, but there isn't one specific. Do it yourself can be the right choice if you genuinely enjoy this work, you have the knowledge to do it well across all the relevant areas. Again, retirement income, retirement taxes, Social Security, healthcare, estate, and legacy. And if you're prepared to stay on top of all these different knowledge areas over the full length of your retirement, then certainly do-it-yourself approach could work for you. For most people, or for more people though, the value of working with the right advisor can go well beyond just portfolio returns. It's clarity about where you stand today, it's confidence that the pieces are all coordinated together, and it's a protection from the mistakes that you don't know you're making, which can and often are the most expensive ones. The biggest risk in retirement isn't paying fees, it's making an avoidable mistake and not finding out about it until it's too late to correct it. So if you're within 5 to 10 years of retirement, or perhaps already there, you've never had someone map out your retirement income gap, your withdrawal rate, your tax picture, and how all of it fits together, that's exactly what we do at Cornerstone Wealth Planning. In the description below, there's a link for you to schedule a free retirement strategy call. When you book that call, we'll walk through your own numbers, show you where you stand today, help you understand what path you're headed towards, and what your future could actually look like. Because the goal isn't just to retire, it's to do it confidently and to stay retired. Book your call now, and we get started immediately. Thanks for watching, and I'll see you on the next video.